Welcome to TalkTickers. You're here for the fast track to understanding what really matters in today's earnings calls.
That's right.
Today, we're diving into the Teladoc Health first quarter of 2025 call.
Yep, gonna bring it all down.
Our mission: to extract the core financial takeaways and strategic moves you need to know without getting lost in the jargon.
Absolutely. So let's kick off with the headline numbers. Teladoc reported $629.4 million in consolidated revenue.
Okay.
Now, that's actually a 3% dip compared to last year.
A dip. Okay.
But it's worth noting they landed right at the higher end of their own predictions. So not maybe as bad as it sounds initially.
Right. Context matters. And on the profitability side, adjusted EBITDA.
That hit $58.1 million. And again, performing pretty strongly there, right up near the top of what they were expecting.
So what does that work out to margin-wise?
That gives them a 9.2% margin.
Okay. Decent.
Digging a bit deeper into the bottom line.
Yeah.
Their net loss per share came in at $0.53.
Okay, a loss. How does that compare?
It's a slight increase from the $1.49 loss they had in Q1 of 2024.
Right.
Now, there's a key thing here. This number includes something called a non-cash goodwill impairment charge.
Ah, the accounting stuff, like a write-down.
Exactly. Think of it as reassessing the value of something they bought before. And that accounted for $1.34 per share, pre-tax.
And that wasn't expected.
Nope, wasn't in their initial forecast. So if you actually pull that charge out, their net loss per share would have been much closer to their higher estimates.
Got it. So the underlying performance wasn't quite as negative as the headline loss suggests.
Precisely. And on the cash front, there's, well, a bit of a silver lining.
Okay.
Their free cash flow showed a net outflow of $16 million.
Still an outflow, though.
Still an outflow? Yes, but it's definitely an improvement compared to the $27 million outflow they had in the same period last year. Moving in the right direction, you could say.
Okay, better than before. And their cash balance, how are they looking there?
Pretty solid, actually. They ended the quarter with nearly $1.2 billion in cash and cash equivalents.
Okay, good cushion. All right, let's zoom in a bit. Starting with their integrated care segment, how did that perform?
Revenue there grew by 3.3% year over year, hit $389.5 million.
So growth there, and that was in line with expectations.
Interestingly, it actually beat their own projections.
Oh, really? What drove that upside?
Well, a couple of things came together. They mentioned favorable timing in some of their risk-based chronic care deals.
Okay.
And they also got a little bit of a boost from positive foreign exchange rates, plus, you know, their recent acquisition of Catapult Health.
Right, Catapult.
That contributed about 90 basis points to the growth number.
Okay. So a few factors helping out there. What about usage? How many people are actually using these services?
Yeah, good question. Their U.S. membership reached 102.5 million.
Wow, okay.
That's a significant 12% jump year over year. And again, better than they anticipated.
That's a lot of members. And virtual visits.
Saw a 7% increase in volume in the U.S.
Okay. And chronic care specifically, those programs.
Enrollment there reached 1.15 million people. That's up 3% from last year.
So growth, but maybe a bit slower than overall membership.
Yeah, they gained new clients and, you know, expanded with existing ones, but that was slightly offset by a bit more attrition than maybe they'd hoped for.
Makes sense. And international integrated care, you mentioned FX helping overall, but how's that part doing?
That side showed some real strength, actually. Revenue grew in the mid-teens when you look at it on a constant currency basis.
Right. Taking out the currency swings, good underlying growth then.
Exactly. Gives you a clearer picture.
So how did all this revenue beat and membership growth translate into profit for integrated care?
Adjusted EBITDA for the segment was $50.4 million. That's a 6% increase year over year.
And the margin?
Margin came in at 12.9%, which again was above their guidance.
It's a strong performance there, driven by the revenue upside.
Largely, yes.
Yeah.
Though they did mention pulling forward some planned spending on paid media, which slightly offset some of that gain.
Okay. All right, let's switch gears then. Let's talk BetterHelp. That's the direct-to-consumer mental health side.
Right. The story there is a bit different. Revenue came in at $239.9 million.
And how did that compare?
That's an 11% drop compared to last year.
Oof, okay. Down 11%. But I think I saw they still beat their own forecast.
They did, yeah. They managed to land above the midpoint of their guidance range.
So what's the story there? Why the drop, but still better than expected?
Well, they pointed to improved stability in the number of average paying users. The decline from the previous quarter, Q4 to Q1, was less than 1%.
So maybe things are leveling out a bit sequentially.
That seems to be the suggestion. And interestingly, the total number of users they had at the end of March was actually higher than at the end of December.
Okay, so paying users stabilizing, total users up a bit. What about the cost side? Bringing in new customers, keeping them?
They said their customer acquisition costs, or CAC, remained relatively stable, and retention rates were pretty consistent with the quarter before.
But profitability took a hit, right?
That's correct, yeah. Adjusted EBITDA was $7.7 million.
Which is down quite a bit.
Down quite a bit from $15.5 million in the same period last year. So the margin fell to 3.2% compared to 5.7% last year.
Okay. Now, the big news on the BetterHelp front was this acquisition, right? Uplift.
Yes, that was definitely a key announcement. Uplift is a virtual mental health company.
What do they do exactly?
They have a network of over 1,500 mental health professionals. And critically, they have arrangements covering over 100 million lives through insurance plans.
So the insurance angle. That's different from BetterHelp's usual cash pay model.
Exactly. Teladoc is acquiring them for $30 million in cash.
Any extras?
Yeah, there's a potential additional $15 million based on future performance and earnout.
And Uplift's financials, what do they look like?
Well, they generated around $15 million in revenue in 2024, did about 114,000 sessions.
Okay. Profitable.
No, they actually had an adjusted EBITDA loss of about $6 million last year, primarily due to investments they were making in their infrastructure.
So Teladoc is buying a loss-making company. What's the strategic thinking here? Why Uplift now?
Yeah, it's a really interesting move. The core idea seems to be leveraging BetterHelp's massive consumer reach.
They definitely have brand recognition.
Right. They have millions of users who are comfortable with online therapy, but maybe prefer or, frankly, need to use insurance.
Makes sense. Therapy can be expensive out of pocket.
Exactly. So Uplift gives them that capability, the network, and the existing payer relationships to start offering in-network benefits coverage.
So the hope is this brings more people in or keeps them longer?
Both, potentially. They hope it'll lead to better conversion rates, more people signing up from that huge funnel of registered users they have.
How many was that again?
4 million registered users last year alone.
Wow.
So better conversion, potentially longer member duration because insurance might make it more sustainable for people, and ultimately capturing a bigger slice of that existing user base.
What are they projecting in terms of revenue impact?
They're being, somewhat cautious initially. They're projecting about $10 million in incremental benefits-related revenue in 2025.
Incremental meaning?
Meaning net of any users who might just switch from paying cash to using insurance. So $10 million new net revenue this year,
okay,
with a much more significant impact expected in 2026 as they presumably scale it up.
Sounds like a pretty major strategic shift for BetterHelp. Are there immediate financial costs associated with this beyond the purchase price?
Yes, definitely. They flagged an extra $10 to $15 million in operating expenses, OPEX, for BetterHelp in 2025.
Where's that money going?
It's for scaling up this new insurance side.
Right.
Things like recruiting more providers who take insurance, technology integrations, that sort of thing. And it also factors in the initial dilution, the operating costs from Uplift itself.
Okay. So integrating Uplift and building out this insurance capability adds costs this year. How does all this affect their overall financial outlook for 2025? Did they change their guidance?
Right. So for the full year 2025, the revenue guidance remains unchanged. Still expecting $2.47 billion to $2.58 billion.
Okay, revenue outlook stable. What about profit and cash flow?
That's where the changes are. Adjusted EBITDA guidance is now $263 million to $334 million.
Lower than before.
Yes, reflecting those Uplift integration costs and investments. And full-year free cash flow projection is also updated, now $170 million to $200 million.
Also reflecting the Uplift deal.
Correct. One interesting point, though, they actually lowered their expectations for stock-based compensation expense for the year.
Oh, by how much?
They're now projecting $100 million to $115 million, which is notably lower.
Okay. And what about the next quarter, Q2 specifically?
For Q2, they're expecting consolidated revenue between $614 million and $633 million.
Right.
With adjusted EBITDA in the range of $56 million to $70 million. And importantly, that range includes the impact of Uplift.
Got it. Okay, let's circle back to the individual segments outlook, factoring all this in. Integrated care first full year and Q2.
Okay, for integrated care, full year, they still expect revenue growth to be basically flat to up 3%.
Okay.
The Catapult acquisition is expected to contribute around 200 basis points, or 2%, to that growth for the full year.
And margins for integrated care?
Adjusted EBITDA margin guidance remains 14.3% to 15.3%. That includes about a 40 basis point headwind or negative impact from Catapult.
And membership numbers, still aiming for that big number.
Yep, holding steady on member guidance. Expecting 101 to 103 million by year end.
Anything else on integrated care outlook? Any risks?
They did mention one potential risk, announced tariffs. They estimate a possible $5 to $10 million hit to adjusted EBITDA in 2025 from those, mostly in the second half.
But that's not in the guidance yet.
Not currently factored into the official guidance numbers, no. Something to watch.
Okay. And for Q2 integrated care specifically?
They're projecting revenue growth of 0.25% to 2.75%. Adjusted EBITDA margin between 13.25% and 14.75%.
And that includes Catapult for the full quarter?
Yes. Q2 will have a full quarter's contribution from Catapult, adding about 240 basis points to growth. They also noted they expect a slight sequential dip in chronic care enrollment in Q2.
Oh, why is that?
It's due to a contract loss they'd previously discussed, but they expect it to bounce back and return to sequential growth in Q3.
Okay, temporary dip expected. Got it. Now, finally, the updated outlook for BetterHelp, factoring in Uplift and everything else, full year first.
Right. So for the full year, they now expect BetterHelp revenue to decline by 3.75% to 9.75% year over year.
Okay, so a wider range of decline now. Why the change?
Well, it includes the expected contribution from Uplift, but it also reflects maybe a softer view on consumer sentiment or spending than before.
Right, the macro environment. Right. Then the margin outlook for BetterHelp full year.
That's now guided at 4.75% to 6.25%. That's down about 150 basis points from their prior guidance. Primarily driven by the Uplift acquisition and those related investments we talked about.
Okay. And for Q2 BetterHelp, what's the expectation?
Second quarter, they expect BetterHelp revenue to be down 7.5% to 11.25% year over year.
Still down, but maybe improving slightly from Q1's run rate.
They did signal a modest sequential improvement from Q1 revenue levels, yes.
And Q2 margin for BetterHelp?
Guided at 2.5% to 5.25%. Again, reflecting the inclusion of Uplift and those initial integration costs.
Okay. One more financial housekeeping item. Did they mention anything about their debt? They have some conduits coming due, right?
Yes. Good point. They specifically said Teladoc intends to use their cash on hand to retire its 2025 convertible bond, which is due in June.
Okay, so paying that off with cash, no new financing needed there.
Seems to be the plan.
Beyond the headline numbers and, the big Uplift news, what else did management seem keen to highlight on the call?
They definitely emphasized the progress they're making on cost savings and productivity initiatives.
Making cuts. Or efficiencies.
More efficiencies, it sounds like. They said they're running modestly ahead of their prior targets there.
Where are these savings coming from?
They mentioned progress in technology and development, administrative costs, and like we noted earlier, stock-based compensation.
So T&D spending actually going down?
They expect overall T&D OPEX dollar spending to be down year over year, yes. And the stock-based comp outlook, as we said, is reduced quite a bit compared to 2024 and 2023.
Okay. They usually have a Q&A session, too. Any interesting nuggets from analysts' questions?
Yeah, absolutely. There were a few good ones. They addressed the impact of offering weekly billing options in BetterHelp.
Right, that's newer. How's that working?
They explained that, well, it does lead to higher churn people canceling sooner.
Makes sense. Lower commitment.
But it also drives stronger initial signups, so better conversion at the top of the funnel. And they said overall, the net effect on the business has been positive.
Interesting trade-off. What else?
They also sort of clarified the rationale for buying Uplift again. They stressed it's about accelerating their entry into the insurance space.
Rather than a problem with BetterHelp itself.
Exactly. Not because of any issues with the core BetterHelp provider network struggling to get payer contracts or anything like that. It's about speed and capability acquisition.
Got it. And anything on revenue per member trends?
Yeah, they touched on that. For integrated care, they emphasized that growing the overall membership base is kind of the first step, a precursor to selling more services to those members down the line.
So maybe lower revenue per member now as they grow, but potential later.
That's the implication. And for BetterHelp, the lower revenue per user currently is partly due to their international growth, where pricing might be different, and also that newer weekly pricing model we just mentioned.
Right. Shorter duration potentially lowers the average revenue per paying user.
Okay. So looking at the bigger picture strategically, what are the main priorities for Teladoc now?
Well, for integrated care, it really seems to be about growth. Growing customers, growing members, and growing usage.
The basics. Right. And leveraging their clinical strengths and, the breadth of products they have to improve patient outcomes, particularly in chronic care, plus integrating Catapult Health effectively to boost their preventative care offerings.
And for BetterHelp, beyond the Uplift integration.
Focus there seems to be on international growth still, experimenting with those new pricing models like weekly billing, and just continuing to enhance the product itself.
And what about the external environment? Any specific challenges or trends they're watching closely?
Management did mention they're keeping a close eye on several things, the usual suspects, medical cost trends, disease prevalence.
Provider pressures.
Yeah, provider pressures, the ongoing mental health challenges across the population, and the broader economic environment, including those tariffs we mentioned.
And they're trying to manage those risks.
They said they're actively working on mitigation strategies where possible. Standard procedure, really.
It's always interesting, too, to see if these companies get any kind of external thumbs up. Did Teladoc get any recent awards or recognition?
They did, actually. They highlighted being recognized in Newsweek's list of most trustworthy companies in America for 2025.
Oh, nice. Where did they rank?
Number 1, actually, in the healthcare and life sciences sector, according to that list.
Wow, number 1.
And they were also included in USA Today's inaugural list of America's most trusted brands. So some positive external validation there.
Okay, let's step back and maybe put on our thinking caps here for the not financial advice segment. Let's unpack this.
Right.
Teladoc's big move, this aggressive push into the insurance-covered mental health space with Uplift, it feels significant for BetterHelp, doesn't it?
Oh, absolutely.
Right.
It's potentially transformative, but like they hinted at with the cost, it could be a bumpy transition too.
Right. Integration isn't always smooth. So here's where it gets maybe really interesting, or at least worth thinking about.
Okay, lay it on us.
Consider this angle. What if the market is just laser focused, maybe too focused, on the short-term hit to BetterHelp's margins? The integration costs, the fact that Uplift revenue won't ramp up instantly.
Yeah, markets can definitely be short-sighted sometimes. Focus on the next quarter or two.
So here's an outrageous but plausible trade idea. And remember, everyone, this is not financial advice, just a thought experiment.
Definitely not advice. Do your own research. Okay, what's the idea?
What about initiating a long position in Teladoc Health, ticker TDOC, thinking maybe 12 to 18 months out?
Okay, a medium-term long bet. What's the outrageous part?
The outrageous part is maybe simultaneously you purchase some out-of-the-money put options expiring, say, in the next 6 to 9 months.
Hedging the downside. Insurance, basically.
Exactly. Hedging against that potential short-term downside risk if the Uplift integration hits snags, or if the economy takes a dive, or if the market just stays pessimistic for a while.
Okay, so long the stock for the medium term, buy short-term puts for protection. What's the plausible part? Why the long bet?
The plausible part is the core thesis behind the Uplift deal itself. If Teladoc does successfully leverage that huge BetterHelp user base...
Those 4 million registered users.
Right. If they can convert a meaningful number of them to using in-network benefits through Uplift, just like they're planning, then the long-term revenue and, crucially, the profitability upside for BetterHelp could be really substantial.
Right, because insurance reimbursement, once scaled, could potentially be more profitable, or at least more stable, than pure cash pay over time.
Could be. And if that happens, it could lead to a significant re-rating of the stock. The market might start valuing that insurance-based mental health piece much higher.
So the short-term puts are your insurance policy against the immediate bumps in the road, the integration headwinds, market jitters.
Exactly. So what does this all mean? You're basically betting on Teladoc's big strategic vision for blending cash pay and insurance in mental health care actually gaining traction.
While protecting yourself if it takes longer or hits more turbulence than expected in the near term.
Precisely. It's a way to play the potential long-term transformation while acknowledging the short-term risks. Again, not financial advice, just an idea to chew on.
A very interesting structure to think about, definitely. Lots of moving parts.
All right, that wraps up our deep dive into the Teladoc Health earnings call. We've hit the key financials, the really pivotal Uplift acquisition, and management's outlook for the rest of 2025.
Covered a lot of ground.
We trust this breakdown has given you a clear, concise understanding of the essential takeaways.
So what stands out to you from all this? What questions are you still pondering about Teladoc's strategy or just where virtual healthcare is heading?
Yeah, that's the big question, isn't it? How will the market ultimately value this kind of hybrid approach, Teladoc's blend of direct-to-consumer cash pay and this growing insurance-based mental health care offering?
It's definitely something to keep a very close eye on going forward. The execution on Uplift will be key.
Absolutely. Well, thanks for tuning in to TalkTickers.
Join us next time for another deep dive into the world of earnings calls.